Remember 2008? It felt like the world's economy was falling apart. But what actually happened? Let's break down the 2008 financial crisis in a way that actually makes sense. It all started with a simple idea. Everyone should be able to own a home. Sounds great, right? In the early 2000s, interest rates were super low, making it cheap to borrow money. Banks started handing out mortgages like candy, even to people who couldn't really afford them. These were called subprime mortgage. Think of it like lending your car to someone you know doesn't have a driver's license. Risky. Now, here's where it gets complicated. Banks didn't want to hold on to these risky loans. So they bundled thousands of them together into a new financial product called a mortgage-backed security, or MBS. They then sold these bundles to investors all over the world, pension funds, other banks, you name it. It was like they took a bunch of questionable ingredients, mixed them into a fancy-looking dish, and told everyone it was a gourmet meal. To make these gourmet meals seem safer, they got credit rating agencies to give them top ratings, like AAA. This was like getting a 5-star review for a restaurant you haven't even tried. Investors saw the AAA rating and thought, this is a safe bet. So they bought more and more. For a while, everything was great. House prices were going up, and everyone was making money. It felt like the party would never end, but then the music stopped. Those low initial interest rates on the subprime mortgage started to reset to much higher rates. Suddenly, homeowners couldn't afford their monthly payments. One by one, they started to default on their loans. When people couldn't pay their mortgage, they lost their homes. With so many houses for sale and nobody buying, house prices plummeted. This is where the dominoes really began to fall. Remember those mortgage-backed securities? Their value was tied to people paying their mortgage. When people stopped paying, those securities became worthless. They weren't gourmet meals anymore. They were toxic waste. And who owned all this toxic waste? Banks and financial institutions around the globe. Massive investment banks like Lehman Brothers, which had been around for over 150 years, suddenly found themselves holding billions in worthless assets. In September 2008, Lehman Brothers declared bankruptcy, and panic spread like wildfire. The entire financial system is built on trust. Banks lend to each other, businesses borrow to operate, and people deposit their savings. But now, nobody knew who was holding the toxic assets. No one trusted anyone. Lending completely froze. It was like the plumbing of the global economy got clogged. This credit crunch meant businesses couldn't get loans to pay their employees, and people started losing their jobs. It led to a massive global recession, affecting millions of lives. In response, governments and central banks around the world had to step in. They bailed out major banks with taxpayer money, arguing it was necessary to prevent a total collapse. It was a hugely controversial move, but it helped to unfreeze the system. The 2008 financial crisis was a harsh lesson. It showed how a problem in one corner of the market, like U.S. housing, could spread and infect the entire global economy. It led to new regulations designed to make banks safer and prevent this from happening again. It was a complex storm of easy money, risky bets, and a failure of oversight. And it's a story that reminds us just how interconnected our world really is. Thanks for watching. If you found this breakdown helpful, give us a like and hit that subscribe button for more simple explanations of complex topics. See you next time.